Have you ever wanted to find out some of the world's most powerful stock market rules? Well, today on the How to Trade Stocks and Options podcast, we have The Trading Habits, written by Steve Burns.
This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we give you the tools, tips, and tricks to help you trade faster and trade smarter. And here's your host, voted one of the top 100 people in finance by Redwood Media Group, founder and head trader of 10MinuteStockTrader.com, Christopher Uhl.
Hey there, 10-minute traders, and welcome back to the How to Trade Stocks and Options podcast. Today, we have an incredible guest, one of my favorite people to have on the show, and I'm so grateful that he and I have been able to connect, Steve Burns, the legend himself, who's been trading for over 2 decades now. And he wrote this book that we're going to have on today discussing. It's called Trading Habits, 39 of the world's most powerful stock market rules. Steve, hey, thank you so much for coming on the show today.
Oh, thanks for having me once again, Chris. It's great to be here.
Oh, I'm thrilled. This was a good book. I don't just get them and set them aside and call you the day of. I actually read these, and so I got a lot of highlights in this one. Let me tell you. We'll do our best to try and keep this under control today, people. But if I don't actually read the entire book to you, then this will be a success. Because yeah, this is great, and Steve was just telling me that it's one of his best sellers.
Yeah, that has been one of the more popular books. At one time, at its peak, Amazon actually put it in prime reading and promoted it. And for, I think it was about an hour one day, I actually had more sales and page reads above Ray Dalio's book, The Principles, for an hour. So that was the most successful thing I had as an author of trading books. And for one moment, I was just a little speck above one of the greatest money managers to ever live as an author. So that was a peak experience.
No,
that's gone very quickly though.
That's incredible. And you think about, this is what Steve pours. He pours his heart and soul into these books. He said it before, but he writes these books because it's the book that he would have wanted someone to write for him when he was learning to trade or in his process of growing as a trader. And yeah, that's incredible. I mean, obviously this is a great book if it's outselling Ray Dalio. Let me tell you that.
Well, that was just for one moment in time, just one brief moment, but it was
one
cool.
Glorious moment. So everything we're going to cover today will be in this book, and I'm going to link a description below for you to get your own copy of Trading Habits, 39 of the world's most powerful stock market rules. So let's get right into it. We're talking on like the first couple pages here. Steve was talking about how after years of study and practice, their mind and bodies react without hesitation, regardless of pressure or uncertainty. And he's referring to the power of habits here. To Steve, let's talk a little bit more about the power of habits. How do you use habits in what you do on a daily basis?
Yeah, I think it's a process of developing strength. Things that make you profitable are things you have to get into a habit of doing. The habit of always cutting a loss short instead of being tempted to let a loser run. Always being the habit of being very open-minded to your winning trades and see how far they will go before they reverse. Things that you quit trying to make yourself do it, or reading your trading plan and trying to do things, or trying to come up with things out of thin air. What should I do this morning? You already know what you need to do. You have your principles and process and rules in place, and you automatically follow them. I think that's a totally different ball game than you trying to reinvent the wheel every morning when you start trading.
That makes a lot of sense to me. And you think of habits in the way of like you put your left shoe on before your right shoe. You put your toothpaste on a toothbrush and you brush your teeth the same way every single day. Habits are repetitive actions that you do basically subconsciously, right? If you're going up the stairs, maybe you always go up on the right-hand side. And when you deviate from that, when you cross your legs the other way, or if you put your fingers together and it's your thumbs on top on the left-hand side, and then you decide to switch it, when you break your habits, it actually feels uncomfortable. And that's what Steve really tries to get across here is you may not have these habits, but these are habits that are very useful, some of the most powerful stock market rules. And if you can make them habits, if you can make them a part of who you are, a part of what you do, it's going to be uncomfortable to do things the wrong way, the less profitable way, the harder way. So this is really cool. I'm excited about going through this with you today, Steve.
It's a new angle to look at it.
Yeah, I mean, that's the way I took it, right? I mean, I'm just thinking, when I go to the gym, right, I'm always working out in a certain way. I have my routine, I have my patterns, and I have my habits that I do there. Now apply the same routines, patterns, and habits to your trading. It becomes second nature. And as Steve just mentioned here, your mind and body react without hesitation, regardless of the pressure or uncertainty. Yeah, I think that's really what the goal of this book should be for the readers out there is to commit these to who you are and to who you trade, or to how you trade, because in any moment in time you can decide to go against your habits, and then hey, you're looking at a screen that you don't want to be looking at. I mean, I've been really guilty of that for sure.
I think like Trader Dante, a quote from him on Twitter where he says, you become your own edge. Once you have the self-discipline, self-control to have created a profitable trading system and a profitable process, and then your ability just to execute that, without a lot of thinking and pondering, you just know what to do and you do it. You become your own edge in the markets.
Mm-hmm. That's well said. I actually just did a podcast on this the other day, and I called this the How to Be a Better Trader. And it was inspired by this next section that I had highlighted here. Steve says, always focus on being better today than you were yesterday. Another way to gain advantage over your opponents is to trade with discipline. Most traders are trading based on their own predictions, opinions, and emotions. These are the worst kind of trading signals. Instead, develop trading rules that will guide you. Replace your opinions with trade signals, and your ego with position sizing, and your emotions with the trading plan. I tell you what, that is prophetic right there. That's one of the best lines I've read in any book, regardless of who wrote it or what kind of book or whatever. I loved this so much, Steve. I mean this. Replace your opinions with trade signals, your ego with position sizing, and your emotions with a trading plan. That's gold right there. I can see how this outsold Ray Dalio.
Yeah, that really quantifies, the battle that everyone, when they first go into the market, and the emotions and the turmoil and the uncertainty and trying to figure it all out, and just the ocean of information. And you have to filter all that information into something that works for you, that meets your goals and your time frame for what you're trying to accomplish. And I think that is, the holy grail people are looking for, is really the same process that anybody uses in any business to be successful.
I agree. Absolutely. And when you are a trader, you've got to consider this your business, right? I mean, you'd said this once before on the program, and I really liked it. I asked you which you prefer, simple moving average or exponential moving average. And you said, I don't care. I prefer the one that makes money. And that's the way you got to be looking at these things, right? Leave your emotions at the door. Leave your opinions at the door. Which one of these is going to help you and help your business at the end of the day?
Yeah, when you go do a back test, you let the back test tell you. You might want to trade a certain way, and you go say, let me see if this works in the past. And you go back and you back test it, and the volatility made it not work. Or, you might love Microsoft and think owning Microsoft right now is the holy grail because it's hitting all-time highs. But you go back and back test it, it was pretty much dead money for the vast majority after its 2000 peak for a very long time before it started trending again. It was the best thing to own in the 90s, one of the best growing stocks in history in the 90s, but then sort of went flat for a long period of time. So you have to take all that into account. That's not what your opinion is.
Yeah, that makes total sense. In fact, the number 2 rule in this book is your trading system must be built on quantifiable facts, not opinions. And Steve elaborates a little bit. He says trading without quantifiable signals means you're trading randomly. That makes sense. Honestly, I mean, let's just say if I don't have a signal, am I going to buy oil today or I'm going to sell it? Let me throw a dart. That's my signal today. Which side does it land on? That to me leads. That's one of the biggest things that I've learned from working with Steve is your trading system must be built on quantifiable facts, not opinions. I had traded based on implied volatility rank exclusively for years. I mean, literally, like, I don't care if it's going up or if it's going down. If the implied volatility rank meets what I want it to be, I'm going to trade it. And I'm going to trade both sides of it. Let me tell you, I'm going to make an iron condor. and I don't care if I'm boxing in the side of the trend. It's going to be fine. And that's really where I learned the most expensive lessons. And there were a lot of times where I, just like a lot of traders out there, was sitting there like, what am I doing wrong? I feel like I'm always losing. I mean, I've got this system that I know works, but it's not working.
Yeah, and a lot of and there are different market environments too. That's another thing is really understanding the edge and the profitability. And if your system is mainly profitable in uptrends, then you're going to be profitable in uptrends, but you may get chopped up in a sideways market. But over the long term, you have a big bull market, and it'll make up for all the sideways action. Or if you have a diversified watch list, you'll have something trending at all times that you can trade, and really thinking through the process, because there is no holy grails. What's really interesting, like you talked about with the iron condors, is some people thought that shorting put options was the holy grail in the early 80s, and people were making livings off of doing nothing but selling short put options over with no hedge, just cash secured put options on the SP 500, and then 1987 in one day Black Mondays blew everybody up. They had made a living off that for years and thought they had the holy grail. So when you do have a system, you got to go back and look at the worst moments. Like if you thought selling call options, I know people that thought selling call options on bank stocks were the holy grail, that had actually, took the cost basis out of some bank stocks, in the 80s and 90s. And then in 2008, a lot of those people just blew up.
Yeah. Interesting.
I mean, actually some stocks that they had actually went to zero.
Yeah.
Mutual and Bear Stearns, several of them that just went down. Like you have to also look at the risk events throughout whatever you're doing. What could happen in the worst case scenario to see if your risk management's in place.
That's something that I've learned essentially, especially is the risk mitigation. I'd always been told, hey, trade small, right? But then what is that? What is trade small? And Steve talks about it's 1% of your capital, right? He's not saying you only need to risk 1% of your capital, but the risk you take needs to be limited to 1%. I think it may have been here, maybe a different book of Steve's, but he was saying that if he's going to enter a trade, he may do 10% of his portfolio in the trade, but the limit of that drawdown will be 1%, period, which I thought was actually pretty genius. You can kind of lever up, and if it works for you, that leverage is great. But if it doesn't work for you, very quickly cut the loss, and that way you don't have any issues.
Yeah, people don't understand the risk of ruin is really just back-to-back large percentage losses, and the working against you in capital. You lose 10%, you got to make 11% to get back to even. You lose 20% of your total capital, you got to get 25% return to get back to even. You go down to 50% drawdown, you got to get 100%. And at that point, you're basically ruined because if you got to do a 50% drawdown, the odds of you being able to double your money is just showing you're putting on too much risk. And so many people continually confuse the 1% risk rule with the position sizing. I'm not saying 1% position sizing. I'm saying 1% loss if you're wrong. So a 10% position size that goes against you 10% would be 1% total trading capital loss. It's like if you can buy the SP 500 accurately, the SPY, and you're only risking a 1% move in the SPY itself, you could put all your money in the SPY, if you're just going to risk and you're going to stop at a 1% against you. So, but so many people, that really disturbs me. People think they know everything and they don't even comprehend that I'm saying the risk of loss of your total trading capital, nothing to do with really position sizing. That's based on volatility.
Yeah, that makes a lot of sense. So number 5 in the trading habits is start with a weekly price chart and establish the long-term trend. Then work down through the daily and hourly charts to trade in the direction of that trend. The odds are better if you're trading in the direction of the long-term trend. So when I read this, I'll be honest, I've never looked at a weekly chart, not once, until I read this. And I was like, maybe Steve's onto something here. So Steve, why would you start with the weekly chart? I mean, are you planning? I had heard someone say once before, you want to look at a chart based on the time frame you're trading. If you're trying to get in and out in just a few minutes, maybe a 1 minute or 5 minute chart. If you're looking to get out in just I shouldn't say in a few weeks, maybe looking at the weekly chart. Is that how that should be interpreted?
Yeah, I think you have to look at the trend of the market itself. I mean, you can even go as far as say, look at the history of the U.S. stock market. You can go back to that, say the history of the U.S. stock market. When it comes to stock indexes, they go up and double and triple quadruple over long periods of time because of the survivor bias of the winners and the indexes. So, the stock market itself has made new highs every so many years for the history of the U.S. stock market. So you can say that. So the bull bias, you have an edge by simply being bullish in the stock market itself. Then you can go and say, are we currently in the monthly chart? Are we currently in a bull market? Are we in a bear market? Are we in the middle of it? So you can know what side has the edge currently. 2008, you start looking over. Right now we're in a bear market, so the long position may not have the edge. Then you can go to the weekly charts, the daily charts. If you're even a day trader, if the market's in an uptrend, you're going to be better off buying a dip during the day.
You trade stocks and options, right? Or at least you want to. Don't skip this ad, but pay attention. You're going to want to hear this. Do you ever feel like you just don't know which stock to pick? There's so many of them out there. Or maybe you even feel like the market is working against you, and that every time you put on a trade, it just seems to go wrong. You're losing, you're sweating, you're always staring at your phone wondering, why does this keep happening? My name's Christopher Uhl, and I was awarded one of the top 100 people in finance, and I'm also the host of the How to Trade Stocks and Options podcast. And I found this awesome service called FinClub.ai that I want to share with you today. FinClub.ai uses artificial intelligence to deliver you the very best stock picks that I have ever seen. And with these stock picks, you're going to be trading with the algos out there instead of against them. This is the kind of tech that the big Wall Street banks use whenever they're placing trades. They really do take the guesswork out of trading, and their win rates on any given day are between 85 and 95%. It is absolutely unreal and just a little scary just how well this artificial intelligence works. So click here to learn more and use the code 10MINUTE, that's 10MINUTE, and you'll get 2 weeks of free stock picks delivered to you every single day. And as a bonus offer, you're going to get your first month half off, and that comes after your 2-week free trial. So now you've got 6 weeks to see just how great the stock picks are at FinClub.ai, where they take the guesswork out of trading. Hey, do you trade options like I do? Then you don't want to skip this, you want to pay attention. I just found the very best options trading platform out there, and I want to tell you all about them. I bet you feel like you're never satisfied with your current options broker, right? Anytime you want to get help, anytime you call them, anytime you email them, you never actually get to talk to a human. And you need to talk to somebody because their platform is so difficult to use. I mean, you've got to go through all these different screens just to place a single trade. And then on top of that, their commissions are eating you alive. You can't even make money because the commissions cost more than your profits. My name's Christopher Uhl, and I was awarded one of the top 100 people in finance, and I'm also the host of the How to Trade Stocks and Options podcast. And Tastyworks is the platform that I use and I recommend. Yeah, I know they got a funny name, but you're going to want to learn more about this platform. It was built by options traders for options traders. So if you're an options trader, you definitely want to check out Tastyworks. It was built on the back of high frequency trading technology. So you're going to be getting close to the best fills possible. And on top of that, their commission structure, it's almost unbeatable. It's only $1 per leg to open a trade and $0 per leg to close a trade. So click the link to check out Tastyworks today and use the code 10MINUTE, that's 10MINUTE, to get over $150 in free 10-minute trader exclusive bonuses just for signing up for a Tastyworks account. It really doesn't get easier than that. You're going to get the best platform that I've ever used, and you're going to get free bonuses from 10minutestocktrader.com. So make sure you check out Tastyworks and use the code 10MINUTE, and you'll be just as blown away as I was by Tastyworks and their options trading platform built by traders for traders.
Rule 6, Steve talks about the more times a support or resistance level is tested, the greater the odds it will be broken. Old resistance can become new support, and the old support may become new resistance. So this one in particular stuck out to me because where I had been taught to trade was that there is no support, there is no resistance. And so when I read this, I was like, I know Steve's a smart guy. I know he's been doing this for a while. Could you tell me a little bit more about support and resistance? What does support and resistance mean to you? Because I've always heard it described as like drawing imaginary lines on a chart. It's not really anything there to quantify that.
Yeah, you can. In a trend, it's true. There are in long-term uptrends there is no resistance, and in long-term downtrends there is no support. That is true. But there's absolutely you go through charts historically that are range bound, you'll see zones of support where there are buyers. They buy the dip. I think right now in SLV, I think it's a $14 support level that's come in on 3 key tests over the last several months. And you can see where a support is an area where there are buyers located. People will step in and buy at that price, and there are no more sellers underneath that price. So it holds the bid and then it moves back up. And it could be a price level. It could be a moving average sideways, like a 200-day, like the Russell 2000 ETF the IWM is right now bouncing off around the 200-day moving average over multiple times, and it's horizontal. There could be ascending. The 10-day EMA could be an ascending support, like we saw during the V bottom reversal recently, where price does not close under a 10-day EMA for months on end. So, from what I've seen, that they do exist, and in uptrends they could be ascending trend lines. They could be ascending moving averages. In downtrends, they could be resistance could be a descending trend line or a descending moving average. So it's just a location people do, and they don't think people make decisions thinking I'm going to buy at this price or I'm going to take profits at this price. Dip buy signals and profit targets on the upside create resistance and support. So that's something I've seen repeatedly. But it is true in a trend. In a trend, there is no long-term support or resistance against the side of the trend. So that's some thoughts that I have and I have seen over and over again. Really, support and resistance are where buyers and sellers are located and ready to take action.
That makes me think of like algorithms, right? Like, let's say if the algorithm is only going to buy when the stock hits $50, and then every time it hits $50, it goes back up from there. I mean, that's my first thought, because obviously a lot of the time when you and I are trading, we're not actually trading between you and I anymore. We're trading more against the computers. I don't know what the numbers are, but I've heard it's staggering. It's like 95+% of transactions are between individual and computer or computer to computer. So that's my first thought when I hear something like a support or resistance, where it's just built in the code at $50 buy, at $73 sell.
It's interesting. Outside of machine learning or AI, algorithms are designed by humans, so they have to create the algorithm that trades. So unless it's doing machine learning or it's doing AI and adjusting and making changes to the market, because that's where we're getting to now. They're all designed by humans. So a lot of the characteristics are built in, and a lot of it is the scalping and the trading of trends and momentum. I mean, they're all programmed. So it's actually, when you have numbers moving, there's not a lot of difference between somebody making an algo versus a human being, except for speed.
Right. Absolutely. The idea that the algorithms run the day, I feel, is becoming more and more prevalent. And I think that's where a lot of people traders should realize that, you're not smart enough to beat the computer. Just let's be clear about that. But you can always play into the computer's game. And that was one of the things that I really took away whenever we were talking about moving averages before, moving average signals that beat, buy, and hold, was that there are trends, and there's a lot that goes into those trends. It's a lot of people who are funding their 401ks. It's a lot of new market participants, following the trend of the market going up overall. But yeah, there's always that involved too. So
the best way to beat high frequency traders is to be a low frequency trader.
Oh yeah.
If I don't trade inside of the daily, if I don't trade intraday, I'm not even participating in the fastest high frequency traders intraday if I wait and make my decision at the end of the day.
Yeah, and that's something I've started doing too, based on our talking. There are times where I look for an entry signal maybe in the first hour to hour and a half of the day, and then I kind of shut it down for a while, and then I'll start looking at it around an hour and a half until closing. Because Steve has mentioned many times in his books that he looks at end of day signals to determine if it's the time to get in or out. And I think I saw you say somewhere that you take profits in the morning and enter positions in the afternoon. Is that right?
Over the long term, I've done that. I've gotten more in the last few years in just absolute end of day signaling for the most part, and just keeping it that. Which recently, there've been some opportunities to take profits in the morning that I have not taken. So, but the longer I trade, the less I trade It's the more I'm just looking at accumulation distribution cycles in the market. And that's what, really that's why the stock market over the long term has gone up as a whole is, stock market itself is under accumulation over the long term.
Right.
I mean, even no matter what algos are doing, either in any given day, on that day intraday time frame, the market's generally either being accumulated or distributed through that day.
Mm-hmm.
There's volatility will change that where you'll go up and make several round trips sometimes. But if you look at charts as accumulation distribution cycles, it'll help making ranges and trends become more clear.
Hey, a little off topic, and you prompted me to think about this. I have been having trouble getting filled lately. I don't know if it's like the overall volume is down. I mean, you could look at a chart and get a sense of the volume, but I feel that it's getting harder and harder to fill, and I'm having to give up more and more on the bid and ask in order to make that happen. Are you having that same
options trading?
Yeah.
Options. Options. You have to be, for me, options, I'm always really careful. I used to have trouble with that on the out of the money whenever I was having a hedge in place on spreads.
Mm-hmm.
I'd have trouble with that a lot in the past. But so I try to really stick with like the highest volume, like SPY or Apple back in the day, and more high volume options. I used to. I haven't done as much option trading lately, but when I do the front month or the weekly and the closest to the money when I trade options. So not done a lot of option trading in recent years either, but when I did, I would have trouble the farther out I got in time and the farther out I got towards the current strike price.
Mm-hmm. Yeah, I don't know what's been going on lately. I mean, I'm having to give up more and more pennies in order to make that happen. So yeah,
the only spread I had trouble with recently was the microcap IWC ETF. I had some trouble in that spread because it's a lower volume. I think it's only between 20 and 100,000 shares a day. But I usually trade only the highest volume markets because I really am strongly of the belief that liquidity is the most important fundamental.
Without a doubt.
If you don't have liquidity, you'll get killed.
Yeah, and you can have a losing trade or a winning trade that just immediately becomes a loser because you can't get out at the winning price.
Yeah, I've had that a few times with options, especially when something went deeply in the money or deep. That's why I've had winning trades that went deep in the money and become illiquid.
Oh yeah, huh?
It's more expensive in the spread than it is in the commissions.
Yeah, it's crazy. Okay, so totally off topic, but I thought I'd ask you about it. Sorry. So we're on rule number 9 here. And this is one I actually really wanted to get your opinion on, especially talking about the ways that you trade. So number 9 is the larger the market gaps, the greater the odds of continuation and a trend. And that's a quote from Linda Raschke. And in here, you went on to elaborate and say, if gaps don't fill in the first hour of trading, the odds are that they aren't going to fill and price will continue in the direction of that gap for the remainder of the day. I find that really interesting. Now, would you feel if that's the same way with earnings or without earnings or just all around?
Yeah, all around it. And Linda really saw that. I think she actually day trades a lot. Once you gap and you give it an hour and see if there's the distribution comes in or the reverse happens. And generally, if there's nobody there to reverse that in an hour, generally that's the direction for the rest of the day. Like how much reward's left in that is in question. Mm-hmm. But that usually shows you where the buyers and sellers are located. Buyers and sellers are always equal. It's just what price they're willing to trade on that changes. So I think that's a big tell, if you have that gap, because that means there were nobody making trades within the gap, whichever direction it goes.
Interesting. Okay, so nobody was making trades in the gap. Now, I've also heard somebody say that all gaps get filled. What's your take on that?
Yeah, that is usually the truth, but when is always the question.
For sure. It can go months,
days,
right?
Weeks, months, years. But yeah, almost everything, even a monster stock, a company that just explodes, at some time will go back. Like JCPenney's did eventually fill all its gaps, and Sears also eventually filled all its gaps. So I believe in the longest time frame, all gaps are filled. But really, the important thing is what trend is going on currently.
Mm-hmm. So we're going to go on to rule number 10, and this actually leads back to what you and I were talking about earlier. The last hour often tells the truth about how strong a trend truly is. Smart money shows their hand in the last hour, continuing to mark positions in their favor. As long as a market is having consecutive strong closes, look for an uptrend to continue. The uptrend is most likely to end when there is a morning rally first, followed by a weak close. So when I read that, you want to see big green candles. But if you start seeing red candles where the close is lower than the open, that's a sign it's going to reverse.
Yeah, that's a sign of distribution. I think William J. O'Neill, one of our most thorough guys that study the stock market ever, William J. O'Neill saw the trends in all the bull markets and bear markets he looked at as they generally, his actual chart study showed him that bear markets generally start high and then end low because people distribute into the strength during a downtrend. And in bull markets, they can start down and finish higher on the day because people find opportunities to accumulate. So that's what he's seen with the markets. And I think it was Linda Roschke. I think she's the one that started that whole thing, talking about the end of the day where it closes. Professionals close the market is a key thing where mutual funds will go and accumulate. They have to accumulate during the highest volume times, and that's usually in the morning or in the evening. So they've really shown their hands when they're accumulating positions for mutual funds, which of course the professionally managed mutual funds are getting less and less as everyone goes into indexes.
Mm-hmm. Yeah, absolutely. And speaking of indexes, we're above the 200-day now, even in the IWM. And that's rule 11. Above the 200-day is where the bulls create uptrends. Bad things happen below the 200-day. Man, I tell you what, if the audience doesn't take any single thing away, it's that. And I was talking to Steve earlier. I love to watch YouTube. People making money, scheming things. What's the latest scheme of the day? And I've been following one guy, and he talks about dividend stocks. And he's got great advice out there in that way. Talking about, this is a great stock because he's very fundamental, which neither you or I are. But he's very fundamental. He's like, I believe in waste management because people always have garbage and it's only going to go up. And they're expanding into other places and they have garbage too. I'm like, okay, I can see your basis there. And he's like, and remember, there's always going to be times when there's going to be uptrends and downtrends. And whenever it's a downtrend, you've just got to hold on to it. And you know that it's eventually going to come back. And I'm looking at him like, what did he just say? I mean, I get where he's going with the fundamental stuff, but he's basically saying, I don't care what price this is, I'm going to hold it all the way to the ground. And yeah, I mean, if not financial advice, if you are going to do anything, just have one line on your chart that says, if it's above 200, okay, things go up, things go down. If it's below 200, I ain't hanging out here anymore. I'm finding the exit door as fast as I can.
Yeah, and it serves two purposes, 200-day, and actually, not just, I talk about it. Paul Tudor Jones, one of the greatest, probably the greatest money manager in history and the best trading results ever. I don't think he's had a losing year in 30 years. I think, if I'm correct, Tony Robbins said during the interview. But he said, one thing he does is get out under the 200-day because things can go to zero. And anything can happen. But, the 200-day moving average serves two purposes. Number one, risk management. When you do have the fourth quarter meltdowns like we had last year, you're not holding all the way down into that pit of despair. So it keeps you out of that, and sometimes those corrections can turn into bear markets, and individual stocks can go to zero. I mean, you get you out of Bear Stearns, get you out of Enron, it's a risk management tool as a moving average. Also, if you've had a long-term bear market or 2008 meltdown or internet bubble pop or whatever, it tells you when you can finally safely get back in. It's an actual trend signal to say, hey, the stock market, it has done going down and it could start going up again. So I think a 200-day moving average is both a risk management tool and a trend indicator that it's safe to get back in the water.
Yeah, and that was one of the biggest. I mean, if you haven't already gone and checked out Steve's book, 50 Moving Averages That Beat, Buy, and Hold, you need to, like now. I'm going to put a link in the description below. That just above the 200 was one of the best performing signals in the entire book, as maybe the Paul Tudor Jones figured out a long time ago. But, I mean, the simplest trading method, which was the SPY end of month above or below 200 moving averages, was one of the best, if not the best return overall in the entire book. Steve, I'm sorry, I just gave away the book. If you people haven't bought it yet, that's the climax of the book, in my opinion. But yeah. I tell you what, the 200-day is so important, and it really has become a part of my trading plan. If it's above the 200-day, I'm looking for a long trade. If it's below the 200-day, I'm not looking for a long trade anymore. In fact, I may be looking for a shorter trade. So what's your take on that?
Yeah, it's a great filter in itself because all we're really trying to do in trading, whatever time frame, whatever markets, is just have big winners and small losers. And you got to have some kind of filter, and that is the best filter for somebody who, even if you're just a part-time person and you just want to manage your 401k or IRA, just getting out when the 200 days lost and it's still underneath on the end of the month basis, that gets you out of the primary disasters of the bear markets, the 2008 meltdowns, the internet bubble popping, the corrections. You're just not in it. And then when it's over and it goes back above, then you can go back in it. I mean, and you're not even dealing with the daily action and the intra-month noise. You're just simply looking into the month going, hey, does it favor me being in or out? And I was shocked too. And that one, I was really shocked when that back test came back. And I think, you got to be kidding me. I went back and looked through historically how accurate that was. I think it recently had a whipsaw recently with some of those quick moves. I think it was last year. But outside of that, it was about as close as you get to a good timing tool. Not a prediction or an opinion, just saying, hey, time to get out. Oh, time to get back in.
Yeah, and it's so simple as well. Just one line, right? If it's above, be in. And if you are the dividend investor, be in, take in those dividends, get your capital appreciation at that point, and you're good to go. That was, like I say, I like to watch lots of videos on YouTube, learning from different people, not necessarily criticizing, but like to get opinions from different people. And while this guy had a lot of great stuff he was putting out, that was one thing where I was like, you need to open your eyes just a little bit more, guy. You're close, but just look at that, and they'll be good to go.
Yeah, the 2000 internet.com meltdown and the 2008 financial meltdown all the way into March 2009 really should have changed some people's mind about buy and hold. Even Warren Buffett does have exit strategies, and his hold strategy is lifetime. Really. So at one point, buy and hold investors, what was it, 2009? I think it was 2009. At one point, they had given back all their gains since 1997.
Whoa.
At one point in the bottom of the 2008-2009 melt. I'll never forget that, thinking I could not. People think I'm crazy for actively trading the stock market. I could not hold my entire lifetime's accumulated capital and watch it evaporate by 50% and get back all the gains I'd ever made since 1997.
Yeah.
Excluding dividends. That would be something I can't do.
And the way the math works is that it has to go through the 200 moving average for things to really start falling apart. It's not an opinion. It's not a good to know. It cannot stay above the 200 and be in a bear market. It just doesn't work like that.
Yeah, the math is just math. You're exactly right. It's a signal based on math, and you're exactly right.
Now, number 21. I'm skipping ahead. I don't want to give away the entire book because I really want you guys to go and check this out. I'm skipping ahead to rule number 21. And I've said this before, but when there's nothing to do, do nothing. Now, Richard Weissman's quoted here in the book, but really, Steve meant me. But cash is a position. When there's nothing to do, don't do anything. Don't go out there. If you don't have anything that meets your signals, meets your criteria, meets whatever you got to help give you a plan, if it doesn't have anything that meets that, don't force it. Because then you're losing money, then you're losing sleep, and then you're like, why did I even do this? So, yeah, what's your take on that? When there's nothing to do, do nothing.
It's sort of like the Hippocratic Oath, first of all, do no harm. People think activity. I think of so many people get into trading, they think they're going to sit at their computer for 7.5, 8 hours a day, and they got to be doing things in trading and going back and forth and doing things all day because, in jobs, you have to work and you get paid for the work you do, and that's how the reward works. But in trading, the reward works by getting and staying on the right side of trends in your time frame, and that doesn't require activity except for clicking a button. And some of the best traders of all time are the least active. Ed Seykota, Nicholas Darvis, market wizard Tom Basso. They primarily just focus on staying long in bull markets. Jesse Livermore, staying long in bull markets and going to cash or having hedges on in bear markets for the stock market primarily. They're not out trying to do anything. All my life-changing money that I ever made in the stock market was made by holding into beautiful trends and looking every day going, wow, that's great. It's still going up. next day, oh, good, it still kept going up, and keep seeing if my signals were hit. That's where the money was made, not sitting in front of 17 screens and scalping every tick, which, if people can do it, make money, which there are some that do, good for them. That's just not my thing. And if you're going to trade 8, 9, 10 hours a day actively, you have to consider what the labor cost of that is for you giving up your time and life that way. How much would you get paid if you work, 40, couple thousand hours a year? That changes your return dynamics when you got to consider you got to pay yourself an hourly time wage for doing all that.
Absolutely. In fact, I think you had said that on the very first time you and I had you on the podcast was, look at your hourly returns. Steve works for about an hour a day and he gets monstrous returns for it. But, the guy that sits in front of 17 screens and is able to make a profit, which 80% of traders or something like that don't. But the guy that actually is able to make a profit, he's taking a lot of time to turn those profits. You're
not just losing money, you're losing time as well. You're risking your time and your money when you spend so much time. I mean, all my time is spent in back testing, studies, and research. Very little time in actual active trading.
So here is something, we're still in Rule 21 that I really, really loved and wanted to get your opinion on. Losing trades happen when a good entry signal leads to your stop loss being hit. So when I read that, that was a huge light bulb moment for me. I mean, like literally that was a game changer when I read that. I was like, wait a minute. Losing trades happen when a good entry signal leads to your stop loss being hit. The losing trades don't come when you hold it for 6 months because you think it's going to turn around. I mean, that was such a light bulb moment for me, Steve. I don't know who else out there this impacted as much as it did for me. But one thing that Steve's put on Twitter a few times, and it leads back to this, is that your trade exit should either be a big win, a small win, a scratch, meaning you break even, or a small loss. This is what he's saying here. Losing trades only happen when you get a positive entry signal, but it was wrong, so it's a false positive, and you hit your stop loss. That's the only time you need a losing trade. That was so monumental to me, Steve. I mean, more than anything else that I've read, that right there really struck a chord so strong, because I've been the guy who did the opposite. But it's so plain, right? You don't have to do that.
The biggest single way to improve trading is to eliminate big losses. Big losses are generally the reason why people are unprofitable. They have big wins. They have small wins, but they might have some small. They generally don't have small losses. They generally have big wins because people hate to admit they're wrong and cut a loss. But if you lose a trade, on a position basis, if a stock goes down 2%, you cut your loss. Stock goes down 1%, you cut your loss. But then you have a stock go in your favor, you make 3%. Stock goes in your favor, you make 6%. You're running a 3-for-1 risk-reward ratio, and your winners are bigger than your losers, and you're profitable. And it really comes down to that is the most powerful math. You have an entry, you stop up for a small loss. I'm not worried about 1 or 2, 3% losses because I plan on making 3, 6, 10% wins. So that's really what the fishing expedition is. And a bad trade is when you don't follow your trading plan. You let a loser run against you. You don't let a winner keep going when there's no reason to get out. And you have to change what a bad and good trade is. It's not necessarily if you make or lose money. It's if you execute your system and trading plan consistently with discipline. Those are all winning trades. But if you don't have a system or plan, then no trade's a good trade.
Absolutely. One thing that I've started doing is in my platform, I can turn off or turn on like the privacy mode, and it doesn't show the balances anymore. I actually really like that. I don't want to know what my account value is at the end of the day. I want to know, am I following my plans? Is what's on the screen a good trade that I want to have on, or is it a bad trade that I need to take off? And if it's a bad trade I need to take off, it certainly should have fallen into this criteria of it just happened and it leads to a bad quick stop loss. And I don't know about you, and I may be crazy for thinking that, but I mean, I know I have enough capital that I can put on pretty much anything I want, but I don't need to see on a daily basis if my account is up or down. I can see on the screen if I am or am not making the right choices.
Yeah, it's so crucial to move your money scoring system to a different time period, maybe end of the
Mm-hmm.
month or whenever you reevaluate or update. I do the same thing. I don't really care about the money. I focus on the execution of my trading plan and strategy, and think more in percentages. This is up 3%, that's up 5%, that's down 2%. I try to, remove the, obsessive compulsive disorder to watch every penny, $10 here, $20 here, which is that's something people underestimate, especially when you get into some size. It's a learned skill to be able to manage and deal with hundreds, even $100 for some people, or thousands of dollars. So you get into 5 digits. I mean, it is a skill to be able to manage that, because most normal people do not used to go, oh, I lost $1,000 this morning, huh?
Yeah.
That's very painful. People associate that with labor wage per hour, or what they get done with it. Very unhealthy road to go down. You have to separate the money from the mentality. I don't think.
Yeah. I was just going to expand upon that a little bit. I mean, when I first started trading, I really wrapped my identity up into, is this a good trade? Is this a bad trade? If it's a good trade, I'm on top of the world. I'm eating good. I'm buying lobster. Everything's awesome. If I got a bad trade, oh, don't talk to me. I don't know what I'm doing. I'm about to have to sell my car or something to pay for this. I mean, yeah. I've come a long way from where I started. And, there was a lot of good luck and a lot of bad luck and a lot of good choices and bad choices. And people like Steve that create the content to be able to give people what they wish they would have known 20 years ago are invaluable. And I'm so grateful that I'm able to connect with people like Steven and others out there that want to share that knowledge. Because I know there's a Maslow's hierarchy of needs somewhere, and there comes a point where it's like you want to share and give back, and that's where Steve's at. Steve wants you to be successful. Your success is his success, and it's not, Steve's out to make a quick buck. No, Steve's trying to help you make some quick bucks. That's what he's here to do. So, yeah, I'm really appreciative for Steve for that, and for creating incredible books like Trading Habits, 39 of the world's most powerful stock market signals, or stock market rules. Yeah. So thank you so much for that, Steve.
I appreciate you having me again, Chris. I really, really have enjoyed the transition into writing the books and in the social media. It's been really fun to do a lot of it.
And you know what? Steve is very, very popular on social media because people understand the value that he brings to the table. And he has a very loyal fan base. I love seeing the people who print it out. I saw this one day on your Twitter. You put out, one of your things where you're like, here's 10 rules to live by. And not even an hour and a half later, some person on the other side of the world had printed out a poster-sized version of that and was hanging it up. And it was like, Steve, I'm going to follow this every day. And I was like, how cool is that? Who has fans like that? That's amazing.
I think it ended up, I remember that. I think it was Julian, I think it's Komar, who he made an image, a meme image of my favorite quotes that I had, that he liked my quotes and put it on a big image. And then it was actually ended up being 4 or 5 people that print them on big printers. I think Instagram, I think I ended up putting some on Instagram. It was like 5. Like you said, I was shocked at that. I thought, that's really, really cool and amazing. Yeah. And then it was like 4 other people or something did it. So there was all these people printing up these posters. I thought, that's really incredible, the power of social media.
Steve, listen, that's the way things are going to go. Young men are no longer going to have Lamborghinis and bikini models on their wall. They're going to have Steve Burns and all of his quotes because they understand the value of wisdom these days. That's what we've come to.
Yeah, it's funny. The 150,000 Twitter followers are the new Lamborghini.
Hey, dude, are you kidding? With 150,000 Twitter followers, that's the difference between you getting a role in a Hollywood movie or not. I mean, really, that followers mean a lot of things. All these people have chosen to say, I want to see what Steve's up to. So that's really cool. So if you already haven't followed Steve, you need to go and check him out. His handle on pretty much everything, I think, is S. Joseph Burns. Now, actually, since I got you on the line, where's Joseph come in here? Is that your middle name?
Yes, that is my middle name.
All right. I've always wondered that. So there you go. The mystery is solved.
Yeah, I tried every combination of Steve Burns from when I went on Twitter, and I was already too late. I think it was about a decade ago. I was already too late to get any variation of Steve Burns, so I had to use my middle name.
Well, it works. There's no other S. Joseph Burns out there. We got the one and only.
Well,
and Steve,
actually, I'm only one of 3. I've
Oh,
got
there you go.
my father's the first and my son's the third. So I'm
Oh,
just
really? I didn't know
tons of me,
that. Okay.
tons of me running around.
Well, Steve, again, thank you so much for first off having written this book and wanting to share your knowledge and expertise with other people. For that, I am extremely grateful and very grateful to have you on the line today and sharing some of that and getting some more of your opinions and knowledge and wisdom out there for more people to learn from and being able to hear it from the man himself. So thank you.
Yeah, appreciate you having me again. I always enjoy talking to you and look forward to this, Chris. You're great to talk to.
I appreciate that very much. It is my true honor to be able to share this with the audience out there. So you know what? We're gonna let Steve go. He's got some money to make, and I appreciate you having coming on, Steve.
Thank you so much.
You're welcome, and thank you guys for tuning in to today's How to Trade Stocks and Options podcast. Hey, if you felt this was useful at all, please make sure you hit the like button and subscribe and enable notifications so you'll know every single time we have people like Steve on and we give you more tools, tips, and tricks to help you trade faster and trade smarter. And I'll see you on the next episode.
Hey, thank you so much for listening to today's How to Trade Stocks and Options podcast. I know you're a listener, but are you a watcher? Make sure you head on over to YouTube, type in 10-Minute Stock Trader, and subscribe to the 10minutestocktrader.com YouTube channel. Every week, I upload all the podcasts as full videos, and that way you're getting the full 10-minute trading experience. That way you can have all the tools, tips, and tricks to help you trade faster and trade smarter. Make sure you subscribe to whatever podcast app you're listening to, and leave me a 5-star review if you don't mind. That would be fantastic. And whenever you're done with that, head on over to 10minutestocktrader.com and download the 1-minute options trading quick start guide. It'll give you all the tools, tips, and tricks that I use in my own portfolio, and it never gets outdated, and it will apply to every single options trade out there, so I think it'll be pretty useful for you. And while you're there, check out the free portfolio page. That'll show you everything that I've traded over the last year in full transparency. And since you're on the website already, check out the free trading course. In this free trading course, I give you every single thing that I know and use in my own portfolio, and I definitely think it'll help you out too. And then, after you're done there, head on over to tastyworks.com and sign up using the code 10MINUTE, that's 10MINUTE, and I'll send you over $150 in free 10-Minute Trader exclusive bonuses from 10minutestocktrader.com. And most of all, thank you so much for letting me be a part of your day. I really appreciate the fact that you and I have connected today and that you've chosen to put me inside your earbuds. That means the absolute world to me. And thank you so much for stopping by. 10minutestocktrader.com content is for information and educational purposes only. It is not, nor is it intended to be, trading or investment advice or recommendation that any security, futures contract, options contract, transaction, or other financial instrument or strategy is suitable for any person. Trading securities can involve high risk and the potential for total loss of any funds invested. 10minutestocktrader.com and Christopher Uhl, through its content, financial programming, or otherwise, does not provide investment or financial advice or make investment recommendations. Investment information provided may not be suitable for all investors and is provided without respect to the individual investors and audience's financial sophistication, financial situation, investing time horizon, or risk tolerance. 10minutestocktrader.com and Christopher Uhl are not in the business of trading securities trades, nor does it direct client commodity accounts or give commodity trading advice, tailored to any particular client situation or investment objectives. 10minutestocktrader.com and Christopher Uhl are not licensed financial advisors, registered investment advisors, or registered broker-dealers. Stocks, options, futures options, and other financial instruments not included here involve risk and are not suitable for all investors. You alone are responsible for making your investment and financial trading decisions, and for evaluating the merits and risks associated with the use of any financial security and broker platform. For more information, please visit 10minutestocktrader.com/legal. And thanks for stopping by.